Hello everybody, this is Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool and one of the founding partners of the Dividend Kings marketplace service on Seeking Alpha. This video is in conjunction with the printed article I wrote, How to Protect Your Dividend Growth Portfolio from the Pending Market Crash. And a couple of points. There are a lot of people starting to question me and ask me about what they should do with their portfolios. They're concerned that we're going to have a market crash and what can they do? Should they go to cash? How should they protect themselves? Now, there's some logic to that. Looking at the S&P 500 here, the last correction we had was the Great Recession of 2008, 2009, and then the only one we had prior to that that's on this graph is 2001. I do want you to notice how short-lived these are. This was one of the longest we've ever had, and that was 2008. But then, the bull market after the 2001 recession lasted several years, and of course this has been one of the longest bull runs on record. So it's logical to assume that at some point there will be a bear market, and I don't think it's a matter of if there'll be one. I think it's a matter of when there'll be one, and I don't know when that will be. But the point is, what can you do to protect yourself? Well, in the article, I primarily pointed out 2 points. If you're a dividend growth stock investor, number one is your dividends are paid on the number of shares you own, not the price per share. So, you can continue to expect to see rising dividend income. And if you're investing primarily for the income, as I personally am and a lot of my clients are, then we're not really worried about short-term price volatility. What we're focused on is to make sure that our dividends keep growing year after year. And then the second thing, and in conjunction or correlation with that, would be the idea that you want to make sure that your portfolio is reasonably valued. And that, to me, is one of the most important issues. You don't want to own significantly overvalued stocks when you're entering a bear market. And I'm going to go through several examples here with this video and talk about how valuation is significant. And the underlying theme here is not all price drops are the same. So if you look at a company like BrownForman, this is a terrific company, A- rated. Dividend record has been spectacular. They've increased their dividend over this 20-year period by almost 9% a year. And they did it through the Great Recession. I want you to notice their dividend increased year after year. They entered the Great Recession kind of fully valued. The market has had a penchant to price this particular company at a premium valuation. If you use the blue line in this example, the stock entered the recession, and it was pretty pricey at around a 20 PE right here. It did fall to what I would call my technical fair value and only had a 31%, sell-off, which was actually better than the market itself. But if you look at this, if the stock was at $15.07 there, it was back to $15 a share by 2010. So that was a relatively short-lived correction. And then, of course, now it's gone on to all-time highs. But my point is this. If I owned BrownForman today, I would be concerned about a pending bear market, because if this traded at the normal PE historically has been very high. If you look back at the history here, it's been over 23. So if I look at it from a standpoint of forecasting and come up with what I'll call use that 23 multiple as kind of my benchmark, and I'm using it ish here, this stock could drop significantly over the next 2 or 3 years. And even if I look at the long-term growth rate and look at a 20-something multiple, I would have negative rates of return over at least the next 5 years and probably beyond. So my point is, if I owned BrownForman, and I don't, I would be very concerned. Even though it's got an impeccable dividend record, the valuation here is so high that it could be an untenable amount of time before I could ever see a recovery. And in the article, I use the example of Cisco, the technology company, Cisco Systems, and I pointed out that they were coming into the recession. Their stock was very highly valued. For the sake of this video, I'm going to use this peak. So when they came into the recession, it did fall to fair value. I'm going to get back to that, but the drop in value there was over 56%. So that's a significant drop. But what I really want you to notice is at this peak price here, the price was $33.13. I have to go all the way out here to 2017, and that's what I referred to in the article as a lost decade. You ended up making no money on this stock for 10 years because it was overvalued in the first place. I want to make that clear. Now, by the way, this is prior to it being a dividend growth stock. It started paying a dividend in 2011, but the point is it was overvalued, and it took 10 years for the stock to recover. Now, had you let's say, bought it when it was fairly valued here roughly, and this is a 15.5 PE, you would have had a recovery in this example in a matter of, just a little over a year. It would have been back up to that $23, $24 value by November, December of 2009. So you wouldn't have had to wait very long, and then eventually you'd have gone on to, all-time highs. Now later on it did get, cheap again, but the point is we're talking about what happens if you hit a recession, and my point is if your valuations are aligned, you're okay. So if you're looking at, a stock like Microsoft is another good example, staying in the tech sector for a moment. If you look at Microsoft coming into the Great Recession, there was a time when they were overvalued, but then when they were fairly valued, had you bought Microsoft there, it did drop. It dropped from the price of $27.27 down to $17, but then it was back up to its $27 value, if you will, by October of 2009. That was a very short-lived bear market, if you will, and of course now it's gone on to all-time highs. But I do want you to notice that this is an extremely high valuation. The company has had some accelerated growth in recent years. It's gone from 10% growth to 17% growth. It is forecast to continue to grow at 12% or so on the 3 to 5 year trend line, and about 13% over the next couple of years. But that still puts it at very vulnerable to a correction. If we did hit a market and stocks, everybody turned pessimistic on stocks, Microsoft would be very vulnerable. And that's what I mean by dangerous overvaluation. If it did fall into fair value from here, it would take an exceptionally long time before you might see your money come back into fair value. In contrast, if I looked at a company that was attractively valued today, Ameriprise Financial, and you can look at it historically, there was no time when the stock was undervalued where it didn't get back at least to the blue line and ultimately to the orange line in a very short period of time. And that's really what I'm referring to here. So if I own Ameriprise Financial and I'm entering the Great Recession, even though the stock might drop. In other words, I wouldn't be surprised to see it drop like it did here, or even, where it was undervalued here and dropped a little bit, but the recovery is going to be very, very quick. So paying attention to the valuation is critically important. And of course, all of this is predicated on the fact that the earnings line, as is expected here, continues to go up. Now, analysts are forecasting, growth for this company going forward. And I might point out that it has a pretty good analyst scorecard. The analysts have been reasonably accurate with this company historically. On a 1 year, they've been accurate over 90% of the time. And on a 2 year, they've been accurate over 80% of the time. So my point being is that I put a little bit of credibility here. I would be very comfortable coming into the next bear market if I owned Ameriprise today or any other undervalued stock. On the other hand, if I owned these very expensive stocks, I'd be a little bit concerned. Now, another point I want to make is, and this is all about fundamentals, if you're looking at like what happened to Walmart, Walmart was overvalued for many, many years here. And Walmart had its own lost decade, if you will, but that was a function of the irrational exuberant period and the stock trading at a ridiculous 55 multiple, which led to years of negative returns, even though the company's business did great. But then by the time they got to the Great Recession, I guess just as circumstance would have it, the stock was actually very attractively valued. And I want you to notice their earnings grew during the recession and their dividends grew during the recession. And they actually did extremely well during the recession, considering this is, a low-cost retailer, if you will, or an economy retailer. The recession didn't really affect Walmart at all. So, but the point is the stock actually made money, and the written portion I showed that it made over 30%. I think I calculated 39. I've used slightly different time frame here, but you can see that in the recession, you'd have made a lot of money owning Walmart. And then even after it corrected back to fair value, you were still ahead of the game. And then, of course, now the stock is trading at a pretty high valuation. I might add, by the way, this is something that always happens with the market. Target, which is not quite as a low-cost provider as Walmart, I want you to notice they came into the recession overvalued, and then by the time they were fairly valued, their stock recovered very quickly. But notice that just recently, the reason I'm showing you this is Target recently got very overvalued, and it's already corrected by about almost 12% since it hit its peak valuation. So, ultimately valuation matters a lot. So if you want to protect yourself and protect your portfolio for a bear market, watch your valuations. Try to stick to companies that are attractively valued and you don't have to worry. But the other side is the idea of the dividend income. If you're lucky enough to be positioned so that all you care about is, or let me say it differently, that the dividends are providing you the standard of living you require, then you don't really have to worry about the recession, because odds are, if you've carefully picked good companies, regardless almost of their valuation, you can expect them to continue to increase their dividend like all the companies I've shown you here have done. Because, the idea is that your dividends are paid on the number of shares, so your income would increase. Here's the dividend of Target, for example, during the recession of '08, and I want you to notice it actually increased by 17% in '08, 15% in '09, 8% in 2010, and then 37% in 2011. So if you were living off the income, you were getting a raise in pay every year, regardless of whether or not the stock price was fluctuating or not. And then finally, I'd like to end this, that all of this is predicated on the fundamentals remaining intact. So I do want you to understand, it's a market of stocks, not a stock market. Here's American International Group. This was one of the worst performing stocks, one of the top 3 worst performing stocks actually during the Great Recession. But I want you to notice this was a result of a complete collapse in the fundamentals. So everything I'm saying here is about owning a company whose fundamentals remain intact. And that just comes from doing your homework, doing your due diligence and your research. If the fundamentals stay intact, the cash flows are good, the balance sheet is strong, the company keeps raising its dividend, you don't have to worry too much about a recession, in my opinion. The really good companies will carry you through the recession without much to worry about. What you want to worry about, though, is even if you own the best company and it's significantly overvalued, it could take years before you see your stock price recover if the stock is overvalued. And of course, if it's overvalued and you hit a recession, once again, it can be a long time. But if the stock is attractively valued or even undervalued and you hit a recession, you can probably see recovery pretty quickly. Anyway, it's been Chuck Carnevale saying thanks for watching. I appreciate it and look forward to talking to you again real soon. Remember, it's a market of stocks, not a stock market. And if you want to protect your portfolios, pay attention to your valuations.